Hi, this video focuses on the topic objective 2.2, which is the 12 key principles of good supervision that's undertaken by MAS. Before we delve into the 12 key principles of good supervision, let me just quickly repeat what we have covered in the last video. All right, in the last video, we covered why MAS is around as a regulator. Their mission, right, in financial oversight in Singapore is to promote a sound and progressive financial service sector. In order to achieve the mission, they come up with the list of objective or desired outcomes in order to achieve that mission. All right. So, and in order to achieve these desired outcomes, they came up with these 6 functions that they need to perform or activities they need to perform to regulate the industry such that they can achieve those objectives and ultimately the mission. All right. So the 6 function is regulation, authorization, supervision, surveillance, enforcement, and resolution. And what do they do to help them to guide them in their activities in these 6 functions? This is where the principles comes in. All right, they are the beliefs that underpins how they are going to conduct these activities within these 6 functions. Okay, let's now delve into the 12 key principles of good supervision. The 12 key principles of good supervision is really split up into 4 different approaches, right? It's under these 4 bullet points, which is risk focused, stakeholder reliant, disclosure based, and business friendly. MAS have always emphasized the need to manage risk. They need the financial institution to take ownership in their own risk management system, and they need to make sure that they have sound system, they have adequate controls, and then they have maintained prudent levels of capital, right, to buffer against possible losses. These are all risk management measures in order to minimize the risk of a systemic failure. Okay, so let's now go into the principles that is categorized under these 4 approaches. Let us start with risk focus. The first principle: emphasize risk-focused supervision rather than one-size-fits-all regulation. This approach of a one-size-fits-all regulation really just means that a supervisor prescribes the activities and the risks that a financial institution can or cannot take. It's analogous to if you have a headache, you just take Panadol. It is a prescribed and a standard prescription to solve an issue. All right. So in this rapidly changing environment, right, we know that the financial industry is going through a transformation, and it keeps changing. So in this climate, this one size fits all regulation has becoming ineffective. All right, and it is very restrictive, for stronger institutions who want to move forward, right? Which with this risk focused supervision, MAS actually evaluates the risk profile of an institution, okay, taking into account the quality of the institution's internal risk management system and processes. This approach actually allows us to give greater business latitude, right, to well-managed institution while retaining higher requirements or tighter restrictions for the weaker ones. The second principle, principle 2, assess the adequacy of an institutional risk management in context of its risk and business profiles. This actually means that MAS takes a proportionate approach when they assess the institution risk. Okay, rather having a fixed view of what MAS would think that is acceptable level of risk that the institution should take, right? Instead of that, they assess their risk management system based on their institution risk and business profile. Okay, for example, if a institution is to engage many complex financial business, right? So this kind of institution must be able to demonstrate that their risk management capabilities are able to match this complexity, are able to be robust enough, right, to match this risk management processes. Okay, while institution having to engage in less complex or risky financial activities, simple products, may simply just have a much simpler risk management processes that is adequate for their purpose. right? So really, if you really think about it, this principle actually follows what principle 1 is actually talking about, which is, you know, to instead of a one size fits all regulation, what we emphasize on risk focused supervision. So this is like a follow up, you know, to principle 1. Principle 3, allocate scarce supervisory resources according to impact and risk. What this actually means is how MAS is going to allocate their supervisory resources, right? Their expertise, the time, among the different financial institutions according to the potential impact that this financial institution would have on the Singapore financial system, their economy, and reputation in the event of a significant mishap, for example, a financial failure or a prolonged disruption of business operation, for example. All right. So institutions that are placed in these distinct supervisory categories are differentiated, right, in terms of the scope and intensity of MAS supervision on them, right? Therefore, more resources will be channeled towards supervising systemically important institution and institution with much higher risk profile. Okay, say in the case of, let's say, anti-money laundering, more resources will therefore be allocated to financial institutions that pose much higher money laundering risk, right? So that's what this principle is talking about. Principle 4, ensure institutions are supervised on an integrated and consolidated basis. Okay, when they mean by integrated, it means across industry, and when it says consolidate, it means cross geography. Okay, what does this really mean? It means that as a home advisor of local, you know, banks, local financial groups, MAS takes an integrated supervisory approach and evaluate these financial institutions across their banking, insurance, and securities activities, right? So integrated. They are also supervised on a consolidated basis, taking into account both their Singapore and overseas operation. Okay, so even for foreign banks that is in Singapore, MAS also make sure, you know, that they supervise across geography, and they work and they cooperate with foreign regulators, which these financial institution has exposure here in Singapore, to do some sort of cross-border supervision and handling of any possible crisis that may come. Right, so this principle basically is telling you that, you know, MAS doesn't really just look at the entity on its own. Okay, it looks across industry, it looks across geography. Principle 5, maintaining high standards in financial supervision, including observing international standards and best practice. Okay, this is the principle that they adhere to in order to strive to maintain high standards, right, in their supervision. They are always benchmarking, okay, itself against international standards and best practices. As an international financial center, as you all know, they have a very strong stake in the global financial stability. So therefore, MAS participates very actively in the regional and international initiatives to enhance regulatory standards and supervisory training. So just for example, I think recently China, you know, is going to come out with their own central bank digital currency, and it has been reported that Singapore is very much involved in that. They are trying to support China in their drive towards digitalization. So with this kind of cooperation across foreign supervisors and regulators, Singapore is putting themselves in a situation whereby they are learning more from the international community, and therefore improving and making sure that the standards that they adhere to here in Singapore is very high. Principle 6. Principle 6 says that MAS seeks to reduce the risk and impact of failure rather than trying to prevent the failure of any institution. I think this is a pretty important principle to follow, right? Whenever they conduct their activities, they have to be sure that they are not out there to save any institution. All right, they are there to regulate and make sure that this institution reduces their risk and the impact. Okay, so MAS is not possible to prevent failures, all right? But MAS requires this financial institution to observe their prudential standards, right? Such as all the limits that they are supposed to adhere to in their capital, in their liquidity, as well as their exposure, right? And MAS have the power to intervene, right? If they believe that the interests of the depositors, the policy holders, basically the consumers themselves are at risk, right? But MAS cannot and actually should not, right? Guarantee the soundness of the financial institution, because this responsibility lies in the financial institution themselves. Even when we talk about consumers, right? Consumers should also recognize that there are risks involved in dealing with financial institution. Okay, one challenge that MAS faces is like any other regulators, is to educate the public, right, about this reality and to manage their expectation, right? Deposit insurance, policy owners protection scheme will make this level of protection, they will make this protection available, right? But consumer at the end of the day should still realize that the risk is inherent in these financial transaction. So let me repeat, this principle basically says that MAS cannot prevent failures, all right? They are only out there to conduct themselves, to supervise the financial institution, to make sure that the risk is reduced. Let's move on to stakeholder reliance, right? Principle 7, placing principal responsibility for risk oversight on the institution's board and management, right? What this really means is MAS sets out, right, to make sure, right, the primary responsibility for the soundness and professional market conduct of any financial institution lies in their board of directors and their senior management, and not on MAS. All right. So it seeks to MAS seeks to reinforce the responsibility of the board, the bosses, to deal fairly with their consumers, ensures their compliance, and maintain adequate risk management of their business activities. Okay, so by doing that, MAS then will minimize the need to interfere with the institution's business decision, right? They don't need to go in and tell them that this is how you should do your business so that you can reduce your risk. The management themselves should be responsible for this risk. Principle 8 under stakeholder reliance. Leverage on relevant stakeholders, professionals, industry associations, and other agencies. What this actually means is MAS believes that they are not the only one and not the only party that's interested in the integrity, the safety, and the soundness of financial institution. Right? There are a lot of other stakeholders. For example, shareholders, creditors, counterparties, people like you and me, depositors, policy holders. They should have an interest on making sure that this institution is healthy, right? Likewise, for professionals such as external audit, internal auditors, actuaries, credit rating agencies, specialists who assess risk, right, inherent in the institution, and the adequacy of the risk management and internal control system. All these people are stakeholders of the whole financial system. In this principle, then of course MAS will make sure that they work with some of these parties. They will interact and work closely with some of them to make sure that this ecosystem, right, that is bringing together the health of the financial system itself. So not just MAS placing their efforts, to making sure that this financial institution is healthy, but rather working with everyone in the ecosystem, in the financial system, so that the whole system remains healthy. Now we move on to the principles that's under disclosure base, right? Principle 9. Rely on timely, accurate, and adequate disclosure by institution rather than merit-based regulation of products to protect consumers. Actually, this is a very important point. Please listen very carefully. Yeah. So MAS has actually moved from a prescriptive merit-based regulations to a more disclosure-based regime under this principle. All right. Under what we call a merit-based regime, right, the regulator assesses the suitability of the product before it's being allowed to be introduced in the marketplace. So meaning under this merit base, the regulator is supposed to look at the products and services that this financial institution is providing and assess the risk and make sure that they are okay to be released to the market. All right, so instead of doing this principle is saying that under this disclosure based regime, the consumer themselves will make well-informed decisions by purchasing the financial products and services based on the material information being made available to the consumer by this institution. Okay, so therefore this is important to understand, because the disclosure based regime, right, will be able to encourage innovation, all right, and facilitate the development of more sophisticated body of consumers. Okay, it is just like a parent, right, letting the child decides based on the information that is given to the child, instead, right, or telling the child that this is good for you, take that. All right, so basically this principle 9 is talking about that. MAS is putting emphasis on this timely, accurate, and meaningful disclosure of information that consumers need to know and reasonably rely on when making their financial decisions. Okay, so this change in this regime, right, moving towards this disclosure based regime, is a very, very important paradigm shift, and this has become MAS guiding philosophy. I think it's important to note. Under disclosure base, we have another principle, principle 10, which says to empower consumers to assess and assume for themselves the financial risk of their financial decision. Right, this is following principle 9, right? But this principle move the focus to the consumer. So if we give a disclosure based regime, we make sure that the financial institution give the correct information, accurate information. Actually, these are meaningless, right, if the consumers themselves do know how to make use of this disclosed information, right? So this principle basically emphasizes on the education of consumers, right? So you will see that MAS works in partnership with a lot of public sector agency and industry body to conduct consumer education to facilitate this. So principle 9, we make sure that the institution is giving informed information to the consumer. Principle 10 is to make sure that this consumer knows how to make use of this information to help them assess the risk on themselves. The last category of the principles falls under business friendly. All right, now we have moved on to principle 11. Principle 11 says to give due regard to competitiveness, business efficiency, and innovation. This is also a very important principle, because MAS do not want to stand in the way of making sure that the market is healthy, letting the market work its way out instead of putting their foot everywhere they go. All right, so this principle tells them to make sure that they undertake supervision in a way, right, that does not unnecessarily impair the competitiveness and the dynamism, okay, of individual institution and Singapore's financial service sector. Okay, MAS take into account the business and operational concerns of the institution and industry, so as not to hinder enterprise and innovation, as long as these are accompanied by good governance and risk management, and supported by sensible and sustainable long-term strategies. Okay, so a very quick example, when we look at MAS giving digital bank licenses, this is really to promote competitiveness in the financial service sector as well. Okay, the last principle, principle 12, is to adopt a consultative approach to regulating the industry. So MAS in this way they are trying to adopt a consultative approach to regulate the industry, right? So they don't want to be the one that dictates what they feel should be right for the financial industry. So they actively seek feedback from market practitioner and the public, to help them develop regulations that take into account market realities and industry practices, right? Consultation also helps to preempt implementation problems, minimize unintended consequences, and foster better industry understanding and support, right? Because in the end, it is really the combined efforts of the MAS and the industry, right, to contribute to financial stability and resilience, while still promoting enterprise and innovation in the financial sector. I think this is a very forward-looking kind of principle. They do not think that they have all the knowledge in order to regulate the industry. Instead, they are always, working with all the stakeholders, all the players in the market, the whole ecosystem, in order to work together to make sure that the regulating part of the whole financial system is very collaborative, right, and consultative instead of what I say counts, right? So the next part is you will probably have to take out your Padlet again. This is another Padlet activity, just to exercise your brain a bit and quickly find a real life example of how MAS is applying Principle 11. Right? Just give a example that you know, or you can search to see whether or not you understand how MAS is applying Principle 11. You might want to start doing now. And then on the next video, we will talk about SGX.